Hi, I'm Professor Suneel Maheshwari with Department of Accounting at Indiana University of Pennsylvania. Today we'll be talking about one more asset, which is notes receivable. And when we will be going over how do we account for the notes receivable, to start with, we will go over the different terms that are used to make a note. Now, creditor is the party to whom money is owed, or the lender of the money. Debtor is the party that borrowed the money or owes the money, or is also called the maker of the note. The maker of the note writes the note and has to pay a certain interest, which is the cost of borrowing the money, and interest is generally stated at an annual percentage rate. Also, the debtor or the maker of the note has to pay that interest to the creditor or the lender by a certain date. So the maturity date becomes important. As far as what needs to be paid to the lender, it is the maturity value, which is equal to the sum of principal, that is the original money borrowed, plus the interest for the period for which the money was borrowed. Principal is the amount that was borrowed, and the term is the length of time from when the note was signed to when the payment must be made. Now, you have to distinguish notes receivable from account receivable, because account receivable is primarily for the goods and services that are normally sold. This is in addition to that, if they want to borrow money for some other purposes, then a note is issued. So the first thing is this is how a format of the promissory note looks like. Now, you've got the principal amount, in this case is $1,000, and the interest period will start from the date on the note, that is August 31st, 2014 for this particular note. And the payee or the creditor is the Continental Bank, in this case, of Chicago. And the maturity date is February 28, 2015. The interest is annual interest at 9%. So this note starts on August 31st, 2014 and matures on February 28, 2015. And the maker of the note, in this case, is the person who has signed the note at the bottom. Now, how do you account for this notes receivable? So after Lauren Handel has signed the note, that is, has agreed to pay $1,000 plus interest to the Continental Bank at the expiry of the loan, at the expiry of the note. So for borrowing $1,000, you've got notes receivable. This is, the bank is making the entry, the creditor is making the entry. So notes receivable is an asset for them because they have got the right to receive the money at a certain point of time for Mr. Holland, and they are paying cash for that notes receivable, $1,000 to Mr. Holland. Now, as far as the computation of interest is concerned, you got $1,000 at 9%. Now, please note the time until the end of December 31st, when the bank accrues the interest at the year end, is 4 months. So 4 months interest will accrue from August to December 2014, although it will not be paid. So in this case, you've got $30 of interest receivable for the bank and an interest revenue of $30. Please note the cash has still not been received by the bank. On the balance sheet for the bank, you have got a notes receivable of $1,000, and interest receivable of $30. And on the income statement, there is an interest revenue of $30. Bank collects a note on February 28, 2015. When the bank collects the note, it will get the cash for $1,045, that is including the interest for the remaining months until the note expires. Interest receivable is from the last year, and interest revenue for 2 months for $15 at 9%. So 1,000 at 9% for 2 months gives you $15. Please note, instead of 12 months, we are computing the interest just for 2 months. So that's why we multiplied it by 2 by 12, and that gets to 15%. And it is recognized as the revenue. So now total of 1,000 of notes, that is the original amount. Interest receivable from the end of the last year for 4 months, which was accrued at the previous year. And the interest revenue of $15 for this month is being received from Mr. Holland. So generally speaking, when you talk about the notes receivable, interest is usually expressed as an annual percentage. And when you compute the time period, which is less than, if it is less than an year, you can do it either on a monthly basis or on a daily basis. So if you have got to accrue or pay the interest for 4 months, then it will be 4 by 12. Or if you have to pay the interest in days, so it might be 120 days over 365 days if it is on a daily basis. So that's how you account for the notes receivable and computation of interest related to the notes receivable. Thank you very much for paying attention.